and welcome to Purple Rasaa podcasts. Early stage founders often struggle to find the right resources amid an overload of information. Purple Rasaa was born out of this need to help these founders access resources that best fit their needs. Our Purple Rasaa podcasts are fueled by curiosity and are meant to inform and empower founders. Follow us for more content and remember, stay curious and keep hustling. Hello everyone. On this podcast today, we have Siddarth or Sid, the CEO of Frontrunner, where he helps founders raise funds faster. And I've known Sid from my days at the Indian School of Business, where we collaborated with their parent organization, Become, on a branding engagement. Sid's energy is infectious, and so is his quest for knowledge. Sid, if I can borrow a line from your profile, I've always come back 1% better from my interactions with you. And Sid also runs a masterclass called How to Pitch Tech for aspiring entrepreneurs. I'll leave his LinkedIn profile in the description. Do follow him to understand how you can join his sessions. So hi, Sid. Welcome to the Purple Rasaa podcast. Good to have you here, man.
Thank you, Suresh. Thank you so much. Excited to get this kicked off.
Same. How are you doing today and how's the weather in Bangalore?
Oh, I'm actually in Hyderabad right now.
Okay.
Yeah, came for a couple of meetings I have on Monday. So I'm in Hyderabad.
Right.
Yeah, the weather is good. It's always a good time, September and October, where we have the end of the monsoon season. So always good to be here.
Right. And talking about what literally brought down the internet last week, do you have tickets for the Coldplay concert?
No, I did make my try, but not really. Unfortunately, it's tougher than the funding ecosystem per se.
There's some news breaking out. The founders of Book My Show have actually been summoned about some foul play in the tickets. Anyway, in this Purple Rasaa podcast, we dive into the multifaceted challenges that early stage startups face. I'm going to quickly share my screen. So through this conversation, we attempt to offer insights into mitigating some of the external factors or external challenges with a focus on fundraising. And Sid, in the last decade of working with startups, I've learned that startups face challenges, and I'm sure you'd also resonate with me from your experience working with scores of founders, that there are many such challenges. Just going to pull in another slide. Yeah. So these are some of the challenges that I feel that startups could be facing, and this got me wondering, why do startups actually fail? It could be the failure to get access to capital at the right point of time or the lack of understanding on how to raise funds. So what is your take on this, Sid?
So I think I'll quickly look at it from a micro and a macro perspective, right? There are both reasons per se. From a macro perspective, yes, the fundraising market has been a little difficult than in 21-22, where we've seen a decrease in the number of seed investments that's been made in India today, comparatively as opposed to 21 and 22. And secondly, the gap between seed and Series A investments has significantly increased. So as per the latest 2023 funding rounds, the financial year 22-23 funding rounds, what we've seen is that from 22-23 to 23-24, the number of startups who have made or who have gotten a seed investment were not able to graduate to Series A investment. Not a lot of investors have shown trust through these startups to put in investments there. So that is definitely happening. And also given the volatility because of wars across the Middle East and also with Russia, Ukraine, and US instability in the US elections, and then also with respect to UK's government being a little unstable, where the government has changed 2-3 times in the last 4 or 5 months itself. So because of a lot of political instability as well, we've seen that the inflow of funds from different FTIs to India has decreased. But that said, there's a lot of promise that's been shown to the Indian economy where a lot of domestic funds have emerged. I've seen that in the last 1 year alone, there have been more than 15 VC funds that are Indian originated and having Indian VCs, Indian LPs invest into these VC funds. So that is from a pure macro perspective, just to give an idea of how the fundraising ecosystem is today. So people used to look at growth before, but people are looking at profitability today. Investors used to look at how well or how how big is the market, but today they're also focusing on how good is the team to execute in that market. So there have been changes as a cyclical changes as expected in the thing. But that said, I'm very confident that the growth of the Indian startup ecosystem in the seed and Series A stage is definitely going to increase as we go ahead. So that's the macro point of view. And because of this macro point of view, some markets like edtech markets, because of the series of events that happened with Byju's and other funds, a lot of there's very less interest shown in such market. But say markets today like people working with artificial intelligence or people working with defense sectors, because government has invested a lot of money in their latest budget for defense. There has been a lot of traction for investors seen in such markets. So that's the macro point of view. So if you're not probably falling under the focus markets for investors, then getting funds is very difficult. So that is from a capital acquisition point of view. One reason that from internal perspective, when I go to micro for a individual startup perspective, access to capital is not the first reason that startups fail. More often than not, from my experience of working in the startup ecosystem from 6 years on various different roles, from GTM to helping someone fundraise, the first biggest reason that I found out on why startups fail, and is also backed with some research that I've done, is co-founder conflict. After having a very good team, or probably say they have achieved a product market fit, I see that because of unresolved co-founder conflict, or the difference in opinion in terms of how they approach decision making within the organization, or how they kind of gel well together, is been the number one reason why startups fail today. Most of the co-founders kind of split during the the pinnacle of growth, during the actual time when the growth rate of a company is drastically increasing. But yeah, sadly, that's one reason. The second reason is, as they say, product market fit is the most commonly used term within our industry. But I feel like not a lot of people actually focus towards the parts that come before product market fit that we can deep dive into as we go into the podcast. But that's the second reason that I have seen where people have failed to understand the stages before product market fit, and actually how can you approach it from a more systematic framework manner, rather than going out there randomly and doing things. So that is something that I've seen. And then the third reason that I see is access to capital will be the third. Is access to capital, not only in terms of money, but also resources, human resources, talented people coming into the team and all that. So these are the top three reasons that I've seen, Shiv.
No, absolutely. I think I resonate with you. And one point that you brought up about co-founders, splitting up. And it's a starting up is a very personal journey, and each startup, I'm sure, will have their own personal reasons as to why they're failing. Thanks for that, Sid. And I'd like to bring the presentation again and move to one important slide that I thought that we can touch upon after this particular point is not everything is actually grim. The latest trends in the global venture capital outlook has some good news. After a year of decline in 2022, the Q2 of 2024 actually saw the global venture capital funding reaching $94 billion across 4,500 deals, which is actually a 5% Q1Q increase. And the top performing sectors, Sid, you mentioned some of them being, AI, healthcare, and financial services. Correct. Gen AI continues to garner considerable investments across categories. With that, let's quickly jump into the topic for today, the pitfalls of fundraising and how to mitigate them. Sid, can you explain to the viewers about the different stages of fundraising or of different stages of startup growth? When and why do startups actually need to raise funds?
Okay, so this is a topic that I've been very curious about from the start of my journey. So I would like to put a startup's journey in what I would call as phases of fit, right? So we more often or not talk about product market fit, as I was mentioning earlier, but there are a lot of stages before product market fit and after product market fit that come into play, even when we look at it from a fundraising point of view. So Let me quickly lay down the basis for you, and then I'll correlate that with the fundraising point. So because fundraising is directly correlated with the growth of the company. The first stage that every founder will go through is what I call as a problem opportunity fit. So within problem opportunity fit, they must have around them in the industry that they're working or adjacent industries, because most of the insights come from working within that industry. So say a founder working in a bank would probably start up is a the employee for a bank started a fintech company. That's how the trend is. So what in and around what they observe is where they identify the problem and they see that there's an opportunity to solve for that particular problem. So within that phase, they kind of deep dive into doing the research on identifying how big this opportunity is, what are the existing players, how are they solving for, who is their customer, and all that. Once that opportunity is established, then the second phase is called as opportunity solution fit. Now, for that opportunity that I've identified, what is the solution that I have to bring to the market? It can be a product, it can be a service, or it can be a productized service. Depending on which industry and what is the need of that particular opportunity, they kind of develop a solution. Most preferably today in VC ecosystem, people fund product companies because of the scale that they can achieve. So that is where the product development and the MVP kind of comes into the picture. Once the solution is fit, then that solution needs to be put down in a product. So for example, let's take the example of Zomato. Zomato started off where Dipender has observed that there are a lot of restaurant menus when he goes to his cafeteria during his lunchtime from Think. So he kind of collated and put together a QR code for accessing all the menus at once. Now that is the solution. Now, but how that solution translated into a product is now he started connecting these vendors or restaurants directly onto this app and onboarding users directly on this app, which is creating an aggregator platform. So the solution was to actually collate all the menus, but the product is actually an aggregator platform. How do you translate this solution to a product is what we call as a solution product fit. Then once the solution is being mapped to the product, that is when you kind of start thinking of product market fit. So within product market fit, you will kind of collate all the insights that you've gathered so far and actually identify who is your target customer that you are going to go after, and then start understanding and defining this particular target audience as the business grows, because you cannot, as a business, you cannot serve all kind of people or all kind of needs. You need to identify their need segmentation, then understand what is it their pain points, then what is the value that you can add through the product, and how much are they willing to pay. So once these points from a feasibility, desirability, and viability point of view are established with a particular customer for the product that you've built, that is when you move on to the next phase, which is called as marketing fit. Now you identified the product, but how do you reach that audience, right? At a scale that you can start making money. So that is where marketing fit will come, and then post marketing fit, we have a marketing sales fit, because you have to start selling, and then that's when the company will kind of enter into the growth stage curve of the thing. So this is typically a cycle that I've observed for early stage companies, where they go from a problem to actually putting out in their market and acquiring users. Now within this stage, the capital also that will be invested in the company will come at different stages. So initially, from product to solution fit, that two phases that I've talked about is -1 to 0 phase. That is where the exploration and everything will come into the picture. Typically, here is where the founder will invest his or her own money to kind of fuel the business and actually explore this opportunity. Once the opportunity has been explored, then the next phase will come, which is from your your product marketing fit. That is where your MVP development, you map the solution to the product, etc. will come. That is where you will raise your first round of investments, either from friends and family or angels that are well known within the industry. So right now you can either raise an friends and family round, or you can raise a angel round directly, depending on the maturity of the company that you can take the thing to. Then the next phase that we have is once you have established that, okay, fine, this is what my MVP is going to be. Now I want to go out and test it in the market and see who my user is. That is where your first round of investment for growth will come into the picture, which is probably a pre-series A round where you want to identify who these guys are, who my target customer is, and actually kind of establish the product market fit. Sometimes it does happen that within the seed fund that you have raised, you will be able to fulfill the product market fit and then directly raise the next round for your growth. From Series A onwards is where your growth capital begins. Now you've done all the figuring out part, you established that there's product market fit, you have built a strong foundational team. That is when investors will start investing on your growth. So Series A, Series B, Series C, Series D, majority of the rounds are focused towards how are you going to use this capital for growth. Before Series A round, the capital that you will be raising will be used for how are you going to use this capital for actually figuring out and achieving your product market fit. So this is broadly how you can classify the investment rounds that happen, especially in the early stage market. Once it kind of enters the growth stage market and the late stage market, the kind of investors will also change. Now, this is how the different types of funding happens correlated with the startup's growth. Now, I'll come to the third segment, which is what are the kind of investors that invest in each of the rounds. So we've named family and friends round. We've named angel round, or also called as a seed round. Then we have Series A round, and there are bridge rounds in between called as pre-Series A, between seed and Series A, and then you have your pre-Series B, etc., etc. So these bridge rounds are especially the rounds where if you have already raised capital, but you were not able to achieve the metrics or the goals that a startup has to hit, then you kind of raise a bridge round to kind of get enough capital to satisfy those criteria and then move on to raising your next round. So within your family and friends round, it's typically your friends who trust you as the founder and believe that you have done enough good work in your past, and you will be they'll be confident enough that you'll be able to do good work in the future with this particular startup. So that is the kind of audience that you will attract. Their ticket sizes are very low, but their risk appetite is very high because they're trusting you and they probably would not have any idea about what you're trying to build or the industry that you're trying to build in majorly. Once that is the first round. The second round is where you kind of raise your angel round. In angel round, there are two kinds of investors. There is individual angels and there's syndicates. Individual angels are people who are either entrepreneurs themselves who are running bigger, growth stage companies or late stage companies, or they are coming from your family offices, or they are already established businessmen in, say, your SMB market, small and medium enterprise market, or they are high net worth individuals from, say, bigger corporations at senior levels. So these are typically the kind of audience that you will find at each stage. So these angel investors have a very small ticket size in India and also abroad. So if you're actually trying to bring someone at this particular stage, what they will look at is, do they have relevant experience in the industry or the problem that you're trying to solve for? Can they add enough value and actually grow the value of the pie that they're investing in, which is the value of the startup that they're investing in? And third is, do they have relevant connections to make in helping them with their growth? So this is the typical criteria that they will look from an investor point of view when they're looking at a startup. And obviously the team, the opportunity in the market, and all the rest of the things that they will look at to trust the idea will also be included in this metrics. Then there is second kind of investors, which is called as syndicates. So typically an angel investor today will have a maximum size of 1 lakh to 5 lakh or 5 lakh to 10 lakh. But as a syndicate, as a company, you probably require 1 crore at that stage. A single investor cannot invest 1 crore in that particular company. So there are angel syndicates that are available today. For example, TIE is one angel syndicate. We have Hyderabad Angels, Chennai Angels, who kind of can gather interest from these such individual angels with small ticket sizes and invest through something called as SPV. So once that invest, why is that an advantage for a founder? Is because they can raise from one institution alone a larger sum of capital rather than bringing a lot of angels who probably are not aligned into their cap table. So that is two kind of investments that happens in angel stage. So once the company then identifies product market fit and moves beyond angel stage, then you have your early stage VC funds or a larger angels that come into the play. So larger angels can include family offices who have larger capacity to either co-lead around or do a follow-on investment. And then typically VCs are the ones who kind of enter at the stage where they start investing from Series A. So Series A onwards, these guys will be focused towards more institutional funds where VCs borrow money from LPs to diversify their portfolio into different startup market based on an investment thesis. So that is how the investment structure of VCs work. Then post VCs, there are late stage VCs who have bigger capacity in terms of ticket sizes. And then you have PEs who have much more larger ticket sizes. So that's how broadly it is being done. If I have to simplify the entire stage for a founder to understand, the smaller the ticket size, the larger the risk. So identify people who are coming at that stage who can give you small ticket size but can take large amount of risk. But as the ticket size grows, it will also institutionalize the fund that is coming from. So the capacity at which they can take risk will also start decreasing. So that is also something that you can keep as a thumb rule as you approach investors. So that's broadly the 3 levels that I covered.
Right. And to the audience, to add on to what Sid said, have you ever given any thought on who are the VC's customers and whom should they serve? Is it the limited partners, the HNIs, or the institutions where the funds come from, or is it the entrepreneurs in whom they have invested in? So do comment your thoughts, and how many founders have had the experience of working with VCs who've had the founder as a customer approach in their daily operations, and what are the benefits of working with such VCs? Do send in your thoughts. Right, Sid. Moving on, now that you've spoken about the stages of funding, how does one actually identify, even identify and even approach these investors? And what stages of funding apply to different types of investors? I think you answered the second part of the question earlier, but how, if we can talk about how can one identify and approach investors?
So typically there's been a misconception that I've seen that people start looking at the outside and then start determining what kind of investors that they want inside. But I think it should more be an inside out approach where they first have to regroup as a team, as a founding team, or with the founding members who are there in the startup, and really understand why do we need capital, how much of capital do we need, what is the stage of the startup that we are at, and then try also understanding where will I deploy this capital. Once you have a good understanding and clarity of answering these 4 to 5 questions that I've mentioned, it will then immediately start boiling down the list of investors that you probably have to approach. As I said, say if you have a very low ticket size and you're, say, just building out your MVP, approaching a VC will not make sense based on the cycle that I've told you. Because if your ticket size is low, the appetite for taking risk is high. But if your ticket size increases, the appetite of taking risk is low. And it is very correlated with the startup journey. So you have to first understand where you place in your own startup journey, what are the positives and what are the negatives that you have, and what are the kind of investor who would probably come at this particular stage. So once you understand this, you'll understand which kind of investment that you have to map to. Say, do you have to look for seed investment? Do you have to look for Series A, or do you have to look for Series D? So that is kind of a classification that will happen. I have worked with companies who directly raise their Series A round without raising their seed or angel, because they were able to sustain till the product market fit and also get to that initial growth phase within the capital that they generated with other means of revenue. So it doesn't necessarily mean that the first round that you raised has to be a seed round. You can probably also raise a Series A round where you approach a VC and tell me, hey, I'm actually looking for a $5 million check because I want to fuel the growth, because this is what I've established so far by being a bootstrap company. So it's a misconception that the first round that you always have to raise is from the angels. That is not true. Or the second round that you have to always raise is from a VC. It depends on the stage at which you're coming and the kind of risk appetite that you as a company will be presenting to an investor. So that's typically a thumb rule. Look inside out and then try identifying what are the kind of investors that you can take in and what is the kind of risk appetite that they can bring to the table. That is number one. The number two that we will look at as an investment, if you're looking for identifying investors, is what is the value that you require that an investor brings into the table. It's just not capital that they're looking at today. It's called as C plus C. It's the experience plus the capital that they bring on, that an investor will bring onto the table when they invest in the company. So identify what are the kind of strengths that you want someone to bring onto the table. It is very contextual. A few startups are very good with technology, but require help with GTM and access to opening doors in a B2B segment. Or a few people are very, very strong with their, their GTM, their distribution network, etc., but they lack in their product. So they want someone who is having access to manufacturing, having access to technology that can improve their product significantly. So it depends on what is the thing that you require apart from the capital as say an advisor or as someone who can help you open the doors. That is something that you will also have to verify. So with both of these things, then that's a very good starting point to identify your ideal investor persona. As we have ideal customer persona, you can create your ideal investor persona and start approaching the market.
Right. I think that's a very important point you brought up, Sid. And give me a moment. I'm going to share my screen again as we move to the other part of the deck here. So staying on the topic of investors, Sid, did you actually know that the corporate venture capital investments have become increasingly significant in the startup ecosystem?
Yes.
It accounts for about 58% of the total venture capital deal value in the US in 23. And India has also seen a 7% year-on-year CVC participation in deals, which is actually a good sign. But as the slide says, founders should weigh the pros and cons of working with CVCs because there are some conflict clauses that may come up. All right.
So one point I'd like to add with respect to CVCs. CVCs typically come post Series A as a round. They start from Series B and above. I had the opportunity to interact with the investment managers of these CVC funds. It's their point of view is that they want to diversify their wealth management, this thing not just in safer assets like gold or say stocks or mutual funds. They also want to deploy capital in much more riskier capital, which can also bring from a strategic point of view a merger and acquisition. So that is how they think it as. So it's very important for founders to understand what thought process that an investor would come to the table and why are they actually investing and where is that money coming from, to really sit on the table. That will help you with negotiations. That will also help you understand how can you bring that particular investor onto the table if they see a fit, and presenting the right set of points that an investor would want to hear. So understanding what happens behind the investor is also very important, and why do they come at that stage, and what is the incentive for them is also something that you need to know.
Right. Right. Moving on, let's move on to fundraising. And it is a very stressful journey, we all agree. And I'd like to ask you, how long does it actually usually take for the money to hit the bank after a founder has reached out to an investor?
So typically in the seed stage round where you're raising from syndicates or angels, it takes somewhere between 6 to 7 months. That is the average time that we've seen. It takes about 3 months or 4 months to get the term sheet, but from the term sheets due to due diligence process adds another 2-3 months to it. If you're actually approaching a VC fund, then you can add another 2 months extra. So it will take another somewhere between 8 to 10 months until the fund is being deployed. The second point that I would like to tell is not all the funds will be given to you at once. It comes to you in tranches. So even the first round of fund is deployed, say you're raising 5 million round, it doesn't mean that all the 5 million will hit the bank account at once. It will hit in tranches of say 1 to 3, sometimes attached with clauses of meeting certain criteria to reach the fund. So for example, say a startup has told that in my projections, I will reach 100,000 users by the end of say October, and I need so much of funds to get there. They will say that I will give you half of the funds first, come up till 500, 5 lakh users, 50,000 users, and then move up to it. So they will give you certain criteria for them to start deploying funds as well. So that's how much the typical life cycle of the fund coming into the market is to your bank account is, and also the time period.
Right. And there was a recent report from the Bain & Company that talks about the rise of insurgent brands, as they call it. They call it the young new brands that cater to the underserved needs of the emerging affluent customer class. And they're actually growing at 3 times faster than the respective categories. So I'd like our audience to leave some of these brands that you know about on the comments. And coming back to Sid, let's address the elephant in the room, which is the cost of fundraising. I think founders mostly, they often overlook the true cost of raising funds. So I'd like to ask you about what is this cost? Let's start with what this cost actually is.
It's somewhere between, if you're raising it in India, somewhere between 2 to 3% of the total fund that you're raising. Say if you're raising $1 million, then you'll probably end up spending $200,000 for getting that fund, or $20,000. It's 1% of that. And then the second is if you're raising from the US, then it's somewhere between 4 to 5% of the total cost of raise. So that is how, so depending on the geography and the kind of investor that you're raising, you as a founder has to invest that amount of money, say 2 to 3% of the fund that you're raising, or 3 to 5% of the fund that you're raising upfront, with a very low probability that you'll actually end up raising those funds. So that is the total cost of fundraise, as we call it.
Right. And what elements do comprise the cost of raising funds?
Sure. There are 5 to 6 elements that comprise of raising such funds. That you will have to incur as a founder to raise these funds. So the first thing that typically happens, where the first set of expenditure happens, is in terms of putting together all the required materials that you will have to present to an investor before going to them. So that includes your pitch decks, that includes your financial modeling, valuation, data room, all the required legal documentations, etc., etc. So that is the first set of costs. The second set of cost is basically the second set of costs that that a founder incurs is mainly in terms of connecting with these investors, spending on identifying, having meetings, traveling, and all sort of things, which is mostly ignored, but it does play a significant role in increasing your costs, right? Not a lot of investors would want to finalize the deal on Zoom Meet. They want you to come to their office and do that. That is the second thing. The third biggest expense that we've seen is in legal fees. What happens is typically once there's a term sheet that's been put into place, there are 3 kinds of due diligence that happens from an investor. There is a financial due diligence, there is a legal due diligence, and there's a business operational due diligence. So financial due diligence will go towards all your projections, all your valuations, the reports that you've submitted so far, any other metrics that is related to the financial health of the company. They would like to audit it and then ensure that whatever information that you've told in the pitch deck is being satisfied with the current trends. So the second is from a legal due diligence, all your agreements, contracts, say the basic ones include your founder agreements, your equity, how is your equity cap table being distributed, etc., etc. All these, and there are various other 32 documents that are required for an investor to kind of validate and cross-check again whether whatever you have told and whatever from a company structure point of view is everything in place. Then the third thing that comes is from a business operations point of view. So they do a background check of the team, the founding team, how long have they been there, is their experience being matched. They also take a reference call from the people that you've already worked with or the customers that you're already serving, etc., etc. So that also takes time. What typically happens is that in the stage of preparing these documents for investors, say if you don't have any document ready or there's requires to be a change, you will give, so during the due diligence phase, it so happens that you will have to create the document, which will take, say, approximately 1 week. Then you send over the document to the investor will send to a lawyer or an investment banker. They will audit the document and then they'll come back to you in 1 week. And then the investor will look at and then take another 3 days to finalize the document from there, and then the document will come back to you. You will send it to your lawyer. It will take another 1 week, and then it will come back to you. And then so one change in a particular document, we've observed that it takes approximately 2.5 weeks to make that change. That is increasing the cost for the founder to fundraise, because they're spending a lot of time and resources for making this happen by investing in a lawyer or an investment banker. And second, the turnaround time is also very huge, which is also adding to the opportunity cost, which is the final biggest cost. As a founder, we believe that the main duty of the founder is to actually raise funds. It's not to actually raise funds, but it's to build businesses, right? But if you're actually spending time to raise funds and not build businesses, then it's a very big opportunity cost that you as a founder are incurring, say, for every minute that you're trying to raise funds, you go out and do sales, you can actually earn revenue. But here, the possibility of you getting that money into the bank is also very low, because when we look at statistics, less than 1% of Indian startups post seed fund get funded. I can drop down that report. There's a very interesting report by Venture Intelligence that they have released on Series A funding. So I'll share that with you. You can add it to the link below. But when you look at the trends like this, that's a very huge upside, a very huge cost in terms of opportunity cost for the founder. So these are mainly how we can bucket and these kind of add up to 2 to 3% if you're in India, or 3 to 5% if you're in the US.
All right, right. And is there a process a founder or a startup can follow that can help them reduce these costs and increase their chances of success?
Yes, I think the first and foremost thing is try to understand who your investor really is, and try empathizing with them and seeing where they are coming from and where that money is coming from, to really understand what are the things that they look at and what are the things that they will require for, even if they are interested in funding in you. There's a very big due diligence process that you can cut down the time and, pre-hand ask them what are the documents that you require. Is there anything that we should keep ready, or have a general understanding saying that 80% of the documents that most of all the investors will require will be the same. 20% are very customizable to the fund or the angel that you're raising from, but at least have those 80% ready in a data room in an organized fashion that will actually save you significant amount of time and money upfront. That is number one. Identify your investor, keep your data room ready. Third, I think there are also people like us who are in the market of helping you get all of these material ready without you actually spending time onto it. The cost of investing in us is a significant upside where you can free up your time and actually build on your business, where both the sides will go on in parallel. Not all startup founders have CFOs or have people who are specialized at getting this material ready in the fastest time possible. So there are people like us who exist in the market. Then the third thing that are also people, as you kind of move up the ladder, say you're raising a Series B, Series C, there are specialized investment banking firms that have started coming up in this space that actually help you reduce this cost of fundraise by taking the end-to-end need catered.
Right. Before we move on to the next one, I wanted to ask you, have you heard of the Asylum Ventures? So they're a small group that is actually pushing back against the VCs that are changing scope and priorities. If you look at VCs, venture capital investing has traditionally involved small groups of financiers who backed very young, risky companies that couldn't obtain traditional loans. That's how venture capital fund started. But since the scope and priorities are changing, these guys are saying we have a $55 million venture fund, and they'll invest in very young tech companies, but they want to make fewer investments over a longer period and in companies that will not need to raise increasingly large funding rounds. So I think this could be useful for somebody who's in this space, may want to follow them. They're called Asylum Ventures. Right, let's move on to the actionable insights part of this podcast that founders can actually take back. Sid, please explain, you spoke about the process and how services like this exist in the market. If you can explain how a well-curated pitch deck or a compelling storytelling and a well-rounded approach altogether can accelerate fundraising and reduce costs. How do you do that, Frontrunner?
Sure. So when we look at early stage investments, as a company, you might not have a lot of track record from a financial point of view or from a data perspective saying to prove that you will be successful in the future, right? It's more of you as a founder trying to tell your vision and the investor resonating with that vision and telling that, hey, I actually believe in what you do and you are actually capable of pulling this off. So hence I'm investing money in you. That's how majority of the term sheets will be put on the table in the seed and Series A stage especially. So since you don't have a lot of track record, you need to sell your vision and you need to sell on your solution that you're trying to build. How will you do that without having concrete data numbers or past record? That is through how you articulate, how well you articulate, and how confident are you with this particular identified opportunity and the product or solution that you're trying to build. So that is where storytelling as a component comes into pitch decks. and that will also help you significantly increase the chances of fundraising and decrease the time that it takes. Because if you have a well-curated story of putting your vision together, helping someone understand about this industry in the fastest time possible, helping them believe in the vision, in the vision through various artifacts that you can put as a case together, it will give confidence to the investors faster. And then with if investors get confidence faster, they will also accelerate the process of fundraising, because they don't want this particular deal or you as a startup to another venture fund, because you probably are solving for a very critical problem or are having a very strong team, etc., etc. So having all of this put together, we've actually seen that with 30 plus startups that we work with, we've seen that this decreased the fundraising time from say 7 to 8 months, as I mentioned earlier, to less than 5 months, just because of the fact that you have a very well put story, and investors wanted to accelerate the process from there, and because the deal didn't want to go to another table and they missed this particular opportunity. That is how storytelling and articulation will help. As you start, so that's the point one. Point two is, as you start articulating the story and as you start putting things together, there's a lot of reflection that happens in terms of how you want to build this business, how do you think you envision this business model, and then you start documenting all of these things, and then start realizing that there are certain other things that I don't have clarity on. So you start seeking them before the investor asks questions to you, which will eventually start leading you to build a data room. Right? Once you start building the data room from a business point of view and the financial point of view, then you can also take help from your friend lawyer or anyone who's in the law to kind of understand what are the documents that are required from a legal point of view. And as you start putting all of these three things together, as I said, it will help you with a faster due diligence process and will also reduce the time that you will take to raise funds. So I think these are a few things that start off with actually helping you reflect and articulate to do this, and that is the core inflection point that we see for someone to start off with creating a very well-made pitch deck or a well-made data room.
All right, and at what points in this journey do you work with startups? Is it just the pitch deck that you help build, or you also take them through the fundraising journey?
Go before the stage of pitch deck, which I mentioned is through the reflection articulation stage. We sit with the founder, we try understanding what their business is, what market are they trying to operate, and kind of pose tough questions to them that will help them reflect back on a lot of things, not just their motivations and what drives them to build in this particular space, but understanding a little bit better on their competitors, on their target audience, and also say how they want to make this business viable, feasible, and desirable. So we kind of go before the stage of creating pitch decks and kind of put all the information together. And if there's any kind of secondary research that is required, that is also something that we do, because we want to free the time of the founder to go and concentrate on their business. So I think all of that things is what we do before actually curating the pitch, and then coming to the pitch deck, articulating that story, creating different versions of the pitch, because a few people will require a teaser, a few people will require a one pager, a few people will require an email deck, you need a presentation deck. So we kind of create all the formats that are required. We also started doing pitch deck because that is something that can help you communicate it more effectively. Video is the most preferred format today. So we put all of this information together and also give you some basic guidelines on how you can start creating your pitch deck, at least from a business point of view and a financial point of view. Legal is something that we don't do today. But once you have all of this material ready, we do all of this in the time period of 3 weeks only. If a founder has to do it themselves, we've seen that it takes somewhere between 2 to 3 months. We are kind of compressing that 2 months time into 2 to 3 weeks and giving all the information that is required in the much more accelerated fashion, so that it doesn't take a lot of time in the initial phases itself.
All right. Right. I think we've covered most of it, and I think one important missing piece is what kind of startup do you work at? Is it and what stage of fundraise should they be? If we can also touch upon that, I think some of our viewers would have that rounded knowledge of how to get in touch with you.
Sure. So we work with seed to Series A founders. That is majorly our focus. So if I have to tell in from a startup point of view where they are at their journey, they should have some sort of MVP MVP product that is ready, or they're trying to figure out their product market fit, they should have enough capital to have a runway of at least 8 months. And say if they already have friends and family who have been invested into this journey, or say a couple of angels who have invested in very early stages of their journey, that is also something that's preferable. So once they have identified their MVP, they have a good core team of whatever number is required based on the industry and the startup that you're building. That is when we kind of come into the picture to start helping them their seed round and their Series A round. So and then we also started helping people raise their bridge round, which is their pre-Series A round. So these are the three major rounds that we focus on. And for startups to raise in these rounds, these are a few prerequisites that any investor would expect to have in the market today. So that is where we kind of come in to kind of accelerate that journey for them.
All right, well said. It's been fantastic talking to you. Thank you so much for doing this with us, and I'm sure everybody tuning in will find this chat as helpful as I did. And to the audience, if you've got any thoughts or stories to share about your own fundraising journeys, drop them in the comment section. And remember, fundraising isn't just about the money; it's about building lasting relationships. And catch you in the next episode. Until then, stay curious, keep hustling. Thank you.
Thank you.